Well, welcome everyone to our webinar on trade and the real economy. Down the line from the University of Cambridge, we have Meredith Crowley. Meredith?
Hi, everyone. Thanks for coming.
Who's going to talk about invoicing and pricing to market. Meredith.
Hi. Well, thanks for having me here. And I'm very happy to be following Dennis because I think my story builds on some of the information he's giving. And so one of the interesting things that Dennis has already pointed out is that the Brexit depreciation in June 2016 was quite large. And it was also essentially a permanent depreciation of the pound. And so we see this, even going out to today, that the pound still maintains that weak position relative to other currencies. So what I want to talk about then is a little bit of a different kind of puzzle. When we look at international prices, outside of a kind of unique experiment like Brexit, where we have a large depreciation and we can see import prices rising in response to that, more generally, if we look at the import prices, one of the things we notice is that in many cases, they're very insensitive to exchange rate movements. And so specifically, there's a literature on what's now known as the international price system that focuses on the fact that exchange rate pass-through into import prices differs across countries, and it also is correlated with the use of the US dollar in invoicing. And so the stylized fact that Gopinath has shared with us all in previous work is that for the United States, which invoices most of its imports in US dollars, exchange rate pass-through into import prices is low. So when the dollar moves against another currency, import prices in the US don't move much. However, if we look at other countries, so for example, Turkey or Japan, that invoice quite a lot of their international imports in US dollars, we see for those countries, exchange rate pass-through into import prices is quite high. And this has led us to an observation that exchange rate pass-through and the amount of price movement in response to exchange rates seems to be correlated with the currency in which firms invoice these transactions. And so in this work that I want to talk about today, which is joint with Giancarlo Corsetti and Lou Han, our question is, what can we learn more deeply about the structure of international prices and the international price system by looking at detailed data on transactions for trade? And specifically, we're going to be looking at transactions data for UK exporters. And a couple of questions we want to answer by doing a study of the pricing of UK exporters is, first of all, if we want to understand the international price system better, and if we want to understand asymmetries in exchange rate pass-through into import prices better, the first place we might want to start with is existing work by people like Gopinath have focused on aggregate levels statistics. So how much is trade for a country in aggregate invoiced in particular currencies, and how is that correlated with exchange rate pass-through? One of the things we want to start with is just, if we look at exchange rate pass-through into prices at the level of the firm, is it still correlated with the currency the firm chooses for invoicing? Another question we might want to ask is, just in general, do firms use just one currency when they invoice their trade, or do firms use multiple currencies? And then a final question we might ask is, if we observe that exchange rate pass-through into import prices varies with the currency that firms use, why is this happening? So another way is, if we think about exchange rate pass-through varying systematically with currencies, is there a deeper explanation for that? And the thing we're going to focus in on is to understand if firms are strategically pricing differently, and if they're strategically changing markups differently when they use different currencies. So Tim, if you could move to the first slide. Okay, so the first one was a disclaimer. This is using data from Her Majesty's Revenue and Customs. They don't endorse the results. They've simply released it and allowed us to say that we don't reveal any firm identifiable data. So if we move to the first substantive slide, sorry, we'll go to back one to share of UK extra EU exports by invoicing currency. So here we have data from 7 different years, 2010 to 2016. And what we've done is we've just looked at for all UK exports, what currency did British firms use for each transaction? Now, at HMRC, UK exporting firms must report the invoicing currency for all trade that goes to countries other than European Union if they export at least £100,000 worth of goods in a single calendar year. So one thing I'll just start out with is if you look across each figure, you'll see the first set of bars says euro, the second one GBP for Great Britain pounds, US dollars, and R stands for non-reported. So this is for those trade transactions whose value is below £100,000 in a given calendar year. They haven't reported their currency of invoicing. The last set of bars refers to other. So these are trade transactions in more minor currencies like the Swiss franc, the Japanese yen, Canadian dollar, etc. So there's two bars for each currency. The first one is calculating the share of exports outside the EU by transaction, number of transactions. And the second one is valuing that up by the total value of exports. So the first observation is over all of these years, the shares in aggregate of different currencies are quite stable. The second fact is that if we look at most trade, about 50% of the UK's export value is invoiced in its own currency, so the pound sterling. And when we want to think about more generally, we refer to a country's firms invoicing in their own currency as producer currency invoicing. Other currencies we observe here, so we see a trade, about a third of trade, 30%, is invoiced in US dollar, roughly around 3% of UK exports are invoiced in euro. Now, for all of these transactions invoiced in euro, we would refer to these as vehicle currency invoicing, because this is the bar for euros represents UK exports that are going to some country other than the European Union, but the British firm has chosen to invoice that transaction in a euro price, okay? When we get to the US dollar, about a third of UK trade is invoiced in dollars. This is a mixture of, a lot of this represents trade going to the United States, but quite a bit also will reflect trade invoiced in US dollars going to third countries. So for example, Canada. And finally, under other, we have currencies like the yen and the Swiss franc. So if we move on to the next slide, the first surprising finding that we can just observe when we look at the UK's trade is we can look for every firm, 8-digit product, and country within a given year. So we have all of these transactions for the UK. If we look within a firm and a product, even within a country, so for example, ABC firm exporting spark plugs to Canada, about 50% of the UK's export value is by firms that within that firm, product, and destination, and within a year, are using only one currency. So they're either invoicing in dollars or in British pound sterling or in euro, but they don't change their currency within the course of 1 year. However, we see from the rows 2, 3, 4 plus that roughly 50% of UK export value originates from firms that are for a single product within a single country, selling the good with 2 different currencies of invoicing. So what this means is that within 1 calendar year, a British firm might be selling a spark plug in Canada, invoiced in US dollar, but then later in the same year, even within the same month or week, shipping another shipment of spark plugs to Canada and invoicing in a second currency, like pound sterling. Okay, so this is one surprising finding. We also see that for UK firms that are importing, about a third of firms that are importing are receiving the same narrowly defined 8-digit product invoiced in at least 2 currencies. So if we move on to the next slide, the first margin of adjustment we saw, our surprising thing, is that British firms are actually using a variety of different currencies. Sometimes they're changing the currency of invoicing within a year. Now, one of the nice things about the Brexit depreciation is it allows us to see how prices of British exporters evolve according to which currency they're invoicing their trade in. So what we're going to do is we're going to take all of the British firms that are exporting products to different destinations in sterling. We'll call these sterling invoice transactions. And then we go through and look, simply we do an analysis of how prices evolved given that a firm was invoicing its exports in sterling. So these are just time dummies. What I have graphed on this picture is 0 is the week of the Brexit referendum. To the right-hand side, we have 78 weeks following the Brexit referendum. We also look at 72 weeks before the Brexit referendum. And the blue dots represent a time dummy that shows how the price differs in that week relative to week 0, the time of the referendum, after putting in firm, product, and destination fixed effects. So what you see here is, as we saw earlier with Dennis's graphs, at the time of the referendum, the sterling is depreciating immediately 10%, and then it's going on to depreciate further, so it's depreciating 15-20%. Now, interestingly, if we just look at the change in the price of Great British Pound goods leaving the country at about week 30, which is going to be about half a year, you can see that there's a small increase in the value, the sterling price of goods leaving the UK, but essentially the sterling price is rising much less than the fall in the exchange rate. So what this represents is a big decline in the price in the destination receiving the goods when denominated in the local currency. So for example, if I'm in Canada receiving goods from the United Kingdom that were invoiced in sterling, here I've got a big improvement in the price I receive in Canadian dollar terms. It's fallen. So this is a picture here. We see a quite sizable exchange rate pass through into import prices. So when the trade is invoiced in sterling, there's actually a big decline in the import price in Canada when measured in Canadian dollars. And so while this is quite sizable in the first 6 months after Brexit, we see over time the prices in pound sterling are gradually creeping up to capture the full change in the exchange rate. Now, if we move to the next figure, here we see a very different picture of the evolution of British export prices over time. And so what I have in this picture is we've graphed out, again, time dummies to show in blue how the sterling denominated price of a British export is changing relative to the price it was in the week of the Brexit depreciation. Okay, so what we have here is measured in sterling just days after the Brexit depreciation, where the pound fell 10%. When measured in sterling, the price of goods that were invoiced in local currencies of foreign destinations were almost immediately raised on the export side. So another way to say this is, if I'm in Canada importing something and it was denominated in Canadian dollars, essentially there was no change in my Canadian dollar price, but there was a 10% change in that good when measured in Great Britain's pound sterling. So very different exchange rate pass-through. Here, essentially, exchange rate pass-through into import prices in the first 6 months after the Brexit depreciation is essentially 0. But over time, we can see actually when measured in sterling, the prices are creeping up. Not surprisingly, the inputs are probably creeping up. But we see actually here that it's moving more than the exchange rate. And so finally, if we move to the next figure, we can see, oops, let's go back to the one more figure. Okay, so here we see for the same picture, the evolution of prices that are invoiced in US dollars. And so here, the general time trend looks very similar to that for goods that are invoiced in the local currency of foreign destinations. First 4 weeks after Brexit, there's not much movement. The first few blue dots stay stable. But then we see in sterling terms, the price of these export goods that are invoiced in dollars move almost one-to-one with the exchange rate. This looks like complete pass-through. The prices are completely stable in local dollar terms. So we don't see that movement. We see the sterling price change, but for the importer that had purchased goods that were invoiced in dollars, essentially it's very low exchange rate pass-through into import prices. So the sum from these three figures is, first, producer pricing is very different from local currency pricing or from invoicing in a vehicle currency like the US dollar. So if we move to the next slide, that will be a table, I believe. So we then take a more rigorous approach to the three figures I just showed you, and we go through and we estimate two things. First, we actually estimate the export price elasticity to the exchange rate. So we look at how much did prices measured in pound sterling change over time. And then we also measure the adjustment of the markup by British firms. So if we start just at the top, column 1 shows us that the export price elasticity for British goods is 0.33. What this means is that in response to a 1% depreciation of sterling, the sterling price would rise by 0.3%. Another way to say this is an implied exchange rate pass-through of about 2/3. So when on average, if we look at all goods, regardless of their invoicing currency, when there's a depreciation of the sterling, pass-through into foreign prices is incomplete, but about 2/3 of that depreciation is going to result in lower 2/3 lower price in the foreign market, or 2/10 of the, should say that again, sorry, I'm getting tongue-tied here. For 10% depreciation of the sterling, prices in the foreign market are going to fall 6.7%. Now, we can break this out by invoicing currency, and the main finding here is if we look at prices invoiced in British pound sterling, and this is represented in column 2 of the study, we see that the export prices are not very responsive, implying quite elastic exchange rate pass-through into import prices. In contrast, if we look at those goods that are invoiced in local currency of the destination market, Mexican pesos for Mexico, Canadian dollars for Canada, we see that actually the export price adjusts a lot. What this means is that when measured in the currency of the destination market, the prices are adjusting much less. So the applied exchange rate pass-through when we have local currency invoicing is only 42%. Similarly, we can look at trade invoiced in US dollars or invoiced in European euro. And the main takeaway here is that exchange rate pass-through into import prices is much higher when British firms are invoicing in pound sterling, their producer currency, relative to when they're invoicing in the local currency of the destination or a vehicle currency like the US dollar or the euro. Now, if we move to the next slide, here, what we're trying to understand is more deeply, why is it that pass-through is so different for firms that are invoicing in sterling relative to other currencies? And the way we do this is we use a new econometric technique developed in some earlier work I have with Giancarlo Crosetti, Liu Han, and Washeng Song, where we develop a new estimator to try to understand and get access to firms' destination-specific markups. So what we do with this estimator is we look at how a firm sets prices differently in different markets, and we look at how these price differentials relative to a firm's average price evolve over time in response to exchange rate changes. The key thing to take away here is if we go to column 1, we look at for the total export price elasticity of 0.33, of that we see that 0.07, or about 20% of that export price adjustment, is due to firms changing their markups differentially across markets. Importantly, all of that adjustment in markups is coming from those firms that are using local currency to invoice their transactions. So essentially what we see for firms that are invoicing in the local currency of a destination, so column 3, when we see how much export prices measured in sterling are adjusting, most of that adjustment is reflected in the firm changing the markups they charge in different countries in response to the exchange rate. So essentially, if we want to understand why there is incomplete exchange rate pass-through into import prices for firms that are invoicing in the local currencies of different destinations, about 84% of that incomplete pass-through is due to the firm selectively and strategically raising or lowering markups in different destinations. Interestingly, for other currencies, so if a firm is invoicing in US dollar, if they're invoicing in euro, or if they're invoicing in pound sterling, the differences in the prices they charge across markets is very, very small. And when there are exchange rate movements, they're not differentially changing their markups across different destinations. And so what this says is that when we might see incomplete pass-through in these countries, it's not due to the firm selectively changing the markups in different destinations. So if we now move to the last slide. So here I'll just say that our objective here is to show that this result that I just showed you, that local currency invoicing is different, that it's involving a lot of pricing to market and firms strategically adjusting markups. It's not just a feature of the Brexit depreciation. But if we stretch out our time window to look at all UK trade from 2010 to 2017, and we look at different frequencies and different currency schemes, we see essentially the same pattern. So on the y-axis, we have the elasticity of the export price to the exchange rate. That's represented by the red dots. We also have the elasticity of the destination-specific markup to an exchange rate, and that's the blue dots. So here you can see that on the x-axis, we have 3 different sets of numbers. So the first 3 numbers, all A, stands for all transactions at the annual frequency. All Q means all transactions at the quarterly frequency. And all M means all transactions at the monthly frequency. So regardless of which frequency window we're using to look at pass-through into export prices and markup adjustments, what we see is essentially that there is some adjustment of the export price when measured in sterling, but there's very little destination-specific adjustment of markups. Similarly, if we go to the right of the figure, whether a firm is invoicing in the producer currency of Britain, the sterling, and whether that's annual, quarterly, or monthly, or if we look at the far right, where we see elasticities for transactions invoiced in vehicle currencies, again, we get the same sort of pattern. Export price elasticities are modest, they're around 0.2, but markup elasticities are not statistically different from 0. The one thing that stands out here is when we look at transactions invoiced in local currency, we see that the export price elasticity is quite high. That corresponds to a low exchange rate pass-through into import prices in the foreign market. And a large portion of this high export price elasticity arises from the firms strategically adjusting their markups differently in different markets. We can extend our analysis to include all trade with the United States, trade with Europe. When this happens, essentially we find more and stronger evidence of a more elastic export price elasticity, and a larger portion of that essentially high export price elasticity is due to firms pricing to market. So for big destinations like the US and the European Union, it seems that British firms are adjusting their markups more to target the specific features of those markets. So to wrap this up, this is my last slide. So why is this important? the key question we started with was essentially, we have a bit of a puzzle when we understand how prices move in response to exchange rate changes. And what we've documented here is that actually a lot of that asymmetry in how prices evolve is due to the currency a firm is choosing for its invoicing. And what we see is that when firms are using the currency of foreign destinations for their invoicing, they're engaging in much more pricing to market. That's important because it means that essentially the price in the foreign destination is quite stable in terms of local currency. And what that means is that there's going to be less inflation passed through from exchange rate movements. In contrast, when we have more of your trade, more of a country's trade being invoiced in the producer currency of the foreign destination, then you're going to have more exchange rate pass through into import prices, and this can lead to higher inflation. So I'll stop there, and thanks everyone for listening.
Thhank you very much, Meredith, and well done on picking your way through that. Not for the first time. I was thinking, I'm glad you're presenting those results and not me. I just have a couple of things on this. Do we have an insight into how typical British firms are of the way firms in other countries would behave?
That's a really good question. And I think one of the interesting things, so first of all, we know, for example, if we look at Canadian firms, most of their trade is going to be invoiced in US dollars because the United States completely dominates British trade. For a lot of countries, governments have not yet released information on invoicing currency. So Dennis might actually have some insights, but we could think that, the UK is probably more similar to a country potentially like Japan or Korea. A lot of their trade is going to be invoiced in the currency of a major destination market. So for those countries, it might be the US dollar because they send a lot to the US. But we might imagine that they're also invoicing increasingly in euro for their sales to the European Union. I guess the short answer is I don't know precisely because a lot of high-income countries have not yet released all of their information on invoicing currency scheme. I've seen a paper on Belgium, which indicates that a lot of Belgian trade is invoiced in euro. So the UK might be a little bit more unique.
So I do know a few things about this because I looked into this recently. The US, as Meredith is saying, is essentially an outlier. The US does everything US dollars, so there's not much change. There's not much variety in different currencies. The Eurozone is also almost a bit like the US in the sense that the Eurozone is very heavy in euro invoicing. And also countries that are very exposed to the Eurozone, that are nearby but not part of the Eurozone or not even part of the EU, also relatively exposed to the Euro. Turkey, for example, or Morocco. They do a lot of invoicing in euros, I guess the obvious reason being they're very close to Europe. But then countries that are developing, like India, they don't invoice anything in their own currency. It's basically zero. And that's quite remarkable. So in some sense, the UK is an intermediate case. It's in between, the US on the one extreme and India on the other extreme.
This, for both of you, this sounds like quite an interesting new angle that we're looking at on trade. The availability of data can break open something quite interesting about the way that firms make decisions.
Yes, and Mark Carney actually talked about this invoicing topic quite a lot. So Meredith explained very well why this matters. And Mark Carney himself at the Jackson Hole conference gave a speech about this very issue. So I think certainly it's up on the mind of UK policymakers, but also more globally.
Meredith, you're going to be doing more of this?
Yeah, I'm actually continuing with more work studying the UK, but also with some other co-authors, we're actually looking at firm pricing by different firms in Africa, different sub-Saharan African countries. Where Dennis spoke about the UK being atypical, we're seeing other kinds of interesting patterns. The dollar is very important for many sub-Saharan African countries, but also in some areas we see a lot of use of particular regional currencies. So the Kenyan shilling seems to be very important in a lot of areas of East Africa outside of Kenya.
Can we model this in as a response to other types of economic shock?
So we could. I think in some ways, the fundamental analysis we're doing here is we're looking at how the price is responding to the exchange rate. And I think in the case of the Brexit depreciation, the fundamental shock is one of information or news, right? So there was a change in people's expectations about future productivity, future safety of the UK economy, and that's what drove the change in the value of the pound. But of course, the value of any country's currency is endogenous, and there's some more fundamental shock that's driving the change. So in many cases, we might have another type of, some foreign country might have a negative productivity shock, and so we could see that the pound sterling would rise in value relative to that country, but then just stay stable or decline relative to another country without a negative productivity shock. So there's the issue is that the exchange rate in a sense is proxying in some cases for conditions in foreign markets. In other cases, it's going to be reflecting some type of shock that's happening in the home country's economy. And so when we have differences in the exchange rate, say the Brexit depreciation is kind of special because it's really a change originating from the UK. But more generally, when we look at changes in the value of a country's currency, we think that they could be reflecting other things. And so we can continue to look at this methodology and the choice of invoicing currency to better understand how prices will move.